Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and we have with us Gene Trowbridge today, who is one of the founders at Trowbridge Law Group. He's a veteran in 506B and 506C offerings, so I think it's going to be really valuable just to hear his experience about raising capital the right way, the legal way, and just want to jump into things. So, Gene, what's going on today?
Well, we're coming down to the end of the year, and it's been a busy year. During the last 3 years of COVID, our practice has grown each and every year. But now we're coming down to where most of our clients have their money raised, and they're working with the lenders and getting ready to get the deals closed by December 31st. And then we'll start with a whole new group of syndications, new clients, new offerings. Probably the last 2 weeks of the year, people will call and we'll get started. So that's what's happening. The marketplace is crazy. There's, I do a lot of multifamily syndications, and that market we had, with interest rates, I think there's some slowing down a little bit. And we'll have to see how that goes in the next month or so. Mason, when I was a syndicator, really my first 20 years in the commercial real estate business, I was a syndicator, and I built self-storage facilities all through Southern California, where I'm located, and we raised our money through the broker-dealer community. So it was an interesting time. We built 32 storage facilities. And one day for a number of reasons, I decided I'd had enough of being the syndicator, raising the money, managing the projects. So I decided to go to law school. So at 45, I went to law school, and I've been doing that ever since. And so the background of actually having been a syndicator and working with other attorneys on my documents has helped me when I work with my clients on their documents. So I have a lot of practical experience on both sides of the table now, because I've been doing this legal work now for 30 years, and I was a syndicator for 20. So I've been in the business a while.
Okay. Yeah, I've heard that having a clear direction in mind before even starting law school is really valuable. It kind of goes for anything in life, I guess, but especially for that, obviously you go a lot of different directions with education, a JD. So
yeah, no, I knew that I was going to work in the securities field, real estate securities, because that's my background. But what I thought was interesting, when I started law school, I thought I would be a perfect hire. Someone would hire me. So the first semester I went to career night, and I found out that there's age discrimination in
Hmm.
in the legal practice. No one was going to hire a 45-year-old guy to come in and be a clerk and start out. And I don't think they thought I'd want to be hired for that. So I knew after my first semester, Mason, that I was going to go on my own, which is interesting because I've never had a W-2 job ever.
Oh,
I've always been self-employed.
okay, interesting. Yeah, and it's funny, even being a youngster like myself when I graduated with my just 4-year undergrad degree, I didn't have a full-time offer lined up, and so nothing's guaranteed anyway, you know. So although I did have W-2 jobs, I actually just recently left mine to focus just on my real estate investing business, but that's good for you that you never had to take one.
Yeah, it worked. It worked pretty well. And this industry I'm in, I know we're going to talk about 506B and some of those terms. This industry is huge. Every year, the in March, the SEC publishes records of how much business was done in the previous 12 months. So the information I have today was published in March of 2022 for the previous 12 months. That's all we have. But during that 12-month period, Regulation D, which is private placements, which is what your listeners are going to talk about, either investing in or being the sponsors, was $2.2 trillion business. More private placement money was raised than IPO money on Wall Street during the same 12 months. So it's a huge business, a room for a lot of attorneys, and just quickly, about 95% of that $2.2 trillion is raised in 506B offerings.
Oh, interesting. Not
Yeah.
necessarily 506C.
No.
Okay. Why don't we jump into that a little bit? So with 506B, you could have up to 35 sophisticated investors that are not accredited, right? So I
Right.
mean, beyond that benefit, what other reasons might someone choose 506B offering versus a C?
The primary reason is the check the box feature for the accredited investors who could just check the box and say they're accredited. We don't need a third party verification like you would in a C. So let's just take one little step back, because when
Sure.
I get homework calls, I call them homework calls. People call me and Mason, they say, oh, I want to put together 5 or 6 investors and to buy a property, but I don't want it to be a syndication. Well, that's a bad question, because the word syndication in vocabulary means 2 or more people combining for a business purpose. Well, so it is a syndication. The question they should ask, and what they really are thinking about, is if I do it that way, does it have to be a security? Okay. And so the court says that a security is when investors pool their money because they expect a profit, not GoFundMe. I need new braces. Send me money and I'll get new braces. That's not a security. But I want to buy an apartment building, send me money and I'll manage it. So it's an investment of money in this common enterprise where they're looking for a profit, but someone is going to manage it. So there's passives and there's actives. And Congress and the SEC has a purpose behind creating laws that protect the passives. Okay, so every security has to be registered with the SEC, Mason, unless it's exempt. And the biggest place for exempt security is Regulation D. And so Regulation D has basically 2 parts to it, 506B and 506C. So the reason we're even talking about it is of that $2.2 trillion, that's all exempt offerings. No one has to get approval from the SEC. So that's pretty darn good. But in the SEC's interest, getting back to your specific question, in protecting investors, 506B, which has always been the rule, Regulation D really came out in 1981, and it created Rule 506. And what it said is you can raise as much money as you want. You can have as many accredited investors as you want. And we're going to let you have some people that aren't accredited, but we're going to manage the risk by limiting it to 35. So I guess if you do a deal and 35 non-accredited investors lose all their money, then the SEC says, we can't police everything. We can't police every single deal. So 35 non-accredited investors. And in that way, there's no advertising. So you should know, no advertising, no general solicitation. So Mason, the sponsor, should know all of the investors. And even more importantly, the investors should have enough knowledge about the sponsor to know about the track record, to know about their business plan, their strategy before they invest. So the 506B lets you have as many accredited investors as you want, and you can raise as much money as you want, because accredited investors are rich and smart. So they don't need the help of the government. The government has too much to do to regulate every single offering. So way back when in 81, when they really defined what an accredited investor was, they set the stage that we're not going to protect those people. They can protect themselves. Of course, that doesn't count if there's fraud or something like that. But as far as what you tell the people before they invest, it's a little more wide open if they're all accredited. But if they're sophisticated, you have a real strict set of rules. And the security rule basically is all about full disclosure. Did you give the investors all the material facts they needed before they invested so they could make an informed decision? That's really what it's about. So if you're doing a 506B, you're writing what we call a PPM. You're writing a private placement memorandum. And that's how you tell the investors all the material facts. It's kind of hard to do that without putting it in writing, because you're going to have conversations with 20, 30 investors over the time. And who knows if you say the same thing to everyone? Who knows if your deal isn't changing as you're going through that process? So put it in writing, give it to the client. And then if there's any question, you can always open the book and say, well, I said that. Or, whoops, that's something I missed. And now the question is, was that important that I missed that or not? So that's 506B. And because we know everyone, the accredited investors just check a box on the subscription agreement that they're accredited. And I think there are 11 different ways to be accredited. And the investor looks down and finds the one that applies and checks the box. No advertising, no soliciting. But that's where 95% of this $2.2 trillion is raised. And a lot of that is because most of the money is raised by broker-dealers, securities reps. People have licenses to sell securities, and they have, I'm going to call it a Rolodex. They don't have Rolodexes anymore, but they have database systems of all these people that they already know. So they already have a pre-existing relationship, so they can raise all the money under 506B. Because they don't need to advertise. So that's where most of the money comes from. Now, if you want to advertise and find people that don't know you, I'm going to be a little facetious or cynical here. Find people who don't know you, who are just thrilled to send you a check for $100,000 and hope that it works. You can go to 506C. In that case, once again, raise all the money you want from as many accredited investors as you can find. No sophisticated investors. You can advertise, you can do general solicitation, but when you find an investor, you have to do a third-party research on whether they really are accredited. And there are companies out there that you gather information on the investor, you send it to the company, and the company runs through all the tests and sends it back to the sponsor and says, yes, that person's accredited. Well, if you've been doing syndication, Mason, with a bunch of accredited investors under 506B, and they're used to checking the box, they don't want to go next door to 506C and have anyone look at their tax returns or their balance sheet. They just want to stay right there. my most prolific clients is since 2014, Mason, has done 160 offerings with me, all 506B, all accredited investors only. And right now his list of investors is frozen. He's not adding any investors to it. And he could never go to 506C because those people just wouldn't want the third-party verification process.
Okay, that's interesting because I've heard that other investors, it might provide them a certain level of comfort knowing that, I don't know, you have some legitimate operation using a third-party verification service provider, but to each his own.
That's fine, but you don't need that in 506B. You just don't need that. I guess that would be a reason to use 506C, but of the 2.2 trillion, I think the number, and I don't quote this very often, so I could be wrong, but you get the impact. I think there was only about 100 million that was in 506C during that same period of time. And it's amazing how small the offerings are, the average offering. I do remember this number, the average offering size in a 506 was smaller than a 506B. Crazy. And our clients, there are some clients who venture into the 506C world. And there are some clients who want to get started in that world. But if you don't have a track record, I don't think it's marketing is difficult. Let's put it that way. But one of the newest things that's happened to us this year, Mason, is a combination offering of 506B and 506C. Have you heard of that?
No, I haven't.
Okay. There was always a problem with a theory called integration, where two offerings done too close together, the SEC would combine them as one offering. And for example, if you've got a 506B offering with 30 sophisticated and a 506B offering with 20 sophisticated, and they integrated those offerings, you would have blown your exemption because you've got 50 non-accredited investors. So that integration rule kind of changed when they said, well, you can do a 506B and then right away you can do a 506C. Oh, okay, but you have to do it in that order because you can't advertise for a bunch of people and then shut that down and take investors because the government's afraid that you're in the second half, you're taking investors that you advertise for, and you're not going to do the third-party verification. So you do the 506B, and when we write the documents, we put in the documents that there's a possibility at some point of time that the sponsor will convert this offering to 506C. And what you have to do is you have to have a specific point in time when that happens. And we do that by filing a Form D, which is the report we give to the SEC at the end of an offering. And we say, okay, the 506B part of this offering is over. Then we file another Form D, which tells them we're starting an offering. And we say the 506C part of the offering is starting now. So there's a definite point of time. And then you can go ahead and advertise. And with the third-party verification, bring people into the offering. And one of the reasons I've seen this a few times in the last half of the year is, in the last 6 or 7 years, there's been a lot of money raised in syndication. And some sponsors are finding that their clients are tapped out. All the money they have for investing is invested. And the properties haven't sold, or they've done an exchange into the next property. But in any event, they've never freed up any capital. So our clients are looking for new investors. And that might be, if you're going to raise $6 million and you already have 5 raised and you have the property and you switch to a 506C, you have a story to tell. That's not exactly investing blindly. Okay, I know what the property is. They've raised 5. They only need another $1 million. Maybe I'll jump in there. So that's where I found that strategy to work, but that's new this year.
All right, that's interesting. Yeah, I also heard that there's been some additional definitions to qualify as an accredited investor. Like if you hold an active Series 7 or I think 63 license or FINRA license, all that.
Sure. Makes a lot of sense, doesn't it? That someone who has gone through the routine of getting licensed by the federal government to sell securities should be knowledgeable about reading the private placement memorandum and knowing what they're getting into, regardless of how much money they make. So yes, they did that. Another one that I find that we're using quite a bit is the rule used to be if it was an entity, a family office, where they have 10, 12 people of family from various ages and education in this family office. It used to be if the family office had more than $5 million of net worth, the family office was accredited, regardless of who's in there. But if the net worth was less than 5 million, you had to go to every person in the family office and see who could invest or who couldn't invest based on accredited or sophisticated. They changed that. It's not 5 million of net worth anymore. It's 5 million of assets. Opens the playing field quite a bit. We see that. And the other one that's kind of interesting, and it's kind of a sign of the times, Mason, is they added the term spousal equivalent to the definition. For example, if you make $200,000 and you file your own income tax return as a single taxpayer, you're accredited. If you're married, filing jointly, and your combined income is $300,000, the married couple is accredited. Or there are all sorts of situations out there where there are two people living together and they're not married, but they have money. Especially in my age group, there are all sorts of people who, two widows live together, or a widower and a widow live together, but they don't want to get married for some reason. And then younger people, that's a situation. So if you're not technically married and you're acting as a household with a spousal equivalent, you can count both incomes. You can count both assets to come up with $1 million of net worth, and you can count both incomes to come up with the 300,000 that was reserved only in the past for married couple. That I see that's effective. The $5 million of assets is effective. I haven't really seen, I'm not exactly sure I would see a big influx of securities brokers investing in the private placement market. They might be investing in their own deals, the ones that are being sold through their company. That might happen, and I probably wouldn't see that.
Okay. So say I have a deal that I feel like it's maybe not worth paying for all these proper documentations and going through that entire process. Is there a way I can maybe do a pseudo syndication that's not actually a syndication that would require me to file these documents? Like if everyone was a GP in my newly created LLC, or how would that work to kind of fly under the radar for a smaller deal? If at all possible.
Well, the only way to do that is to make sure that no one is in charge of anyone else's money. Every major decision. I mean, you could go out and let's say you get 5 people, you put them all in an LLC. They're all members of the LLC. And then you hire a property manager. Well, the property manager is going to make all the day-to-day decisions, and the decision to hire the property manager was a unanimous decision from all the investors. And then when it comes down to, is it a single tenant retail center, they would all have to vote on who the tenant would be if you had to re-tenant it. They'd all have to vote on refinance. they'd all have to vote on a sale. And regardless of the amount of money that each person has invested, Mason, it would have to be a unanimous vote. So my example of 5 members, there would be 5 even votes, 5 equal votes. And if you didn't have unanimous approval, you couldn't do it, because the minute you can control someone else's money, it's a partnership, it's a security, and away you go. So it's very difficult to pull that off. We have people who do offerings with one investor. Okay. And the sponsor has an investor, and they go out and find the property, and the investor puts in 95% of the money and the sponsor puts in 5, and away they go. But if the sponsor has control of those major decisions, that's a security. So we try to write that so that the major decisions are a vote, a unanimous vote. Just because you have 95% of the money is in there doesn't mean you can make the rules, but actually it does. You know how that would work. If the guy said, yeah, I want to sell, the lady says, I want to sell, and you don't, but you only have 5%, you're probably going to sell if you want to do more business with that person. So yeah, we get that. Like I said, we get a lot of homework questions. How do I get out of making it a security if I'm raising money from 10 people? The major questions I get, if it's just family and friends. Well, there's no exclusion for family and friends. Family and friends is good because those are people with whom you have a pre-existing relation. And so they fit right in 506B, whether they're accredited or not. Now, whether investing with family and friends is a good idea, I'll leave that up to the sponsor. But that's a question I get. And the other one is, well, if everyone's accredited, it's not a security. Not true. However, if everyone is accredited, you technically don't need to write a private placement memorandum because they're all rich and smart. They should be able to study and read and ask you the questions so they can make a decision to invest. The problem is you as a sponsor are still held subject to, did you give them all the material facts ahead of time so they could make an informed decision? And I think the only way you can prove that you did that, defend yourself, protect yourself, is to put it in writing. It may not have to be 100 pages like some of them are where they're sophisticated investors, but you at least have to tell the investors everything.
Okay. That kind of leads to the next question is, you think there's like a minimum amount of capital that needs to be raised for it to make sense to go down this route of a syndication?
I don't think that's an issue. I think anywhere you go in the marketplace today, you're going to pay $10,000 to $15,000 minimum to get all the paperwork done. Okay, so if you're raising $300,000, does that make sense? I don't know. If it doesn't make sense, then don't make it a security. Find a couple people that you can put in as a member managed LLC as opposed to a manager managed. If it's a manager managed, it's a security, period. Limited partnerships, by definition, are securities because the general partner makes all the decisions. The limiteds don't make any. So by definition, that's always a security. So I guess there are a couple exceptions I haven't mentioned that you could go. You could try to do a deal under the good deal exemption. If everything goes right, no one cares what you did. Or the under the radar exemption. The deal is so small, you're not going to file a Form D. How are they going to find you? Both of those fall apart if the deal goes bad. Or an investor dies and the family needs their money back. And they come to you and say, we need the money back. You don't have the money because the money's in the building. Then the attorney calls you and says, hey, I've made this call many times. How is it that, Mason, you took Gene Trowbridge at his age into this deal and it's not liquid? How are you going to get his money back? His family needs it. So you don't want that phone call.
That makes a lot of sense. Also, do you feel like it's wise to do like a certain number of transactions with other investors, like specifically passive investors, before actually doing a syndication?
Well, I don't know how you can. I mean, you have to see the second question an investor is going to ask you is, have you done this before? So you're going to have to point to something. When I started, I had to answer that question. No, I haven't done it, but I own properties myself. I've been a broker. I know the transaction goes. I'm a CCI, I'm a CCI instructor, all those things. I'd have to convince people that I had something in the background so that they'd want to invest with me. So I think the first question an investor should ask, and when I'm going to go through these four, and I think it's important because if the investors are going to ask it, the people who are listening to you who are going to be syndicators need to have the answer. Okay. The number one question is, hey, Mason, if I give you the $50,000 for this deal and something happens to you, what happens to my money? We won't do an offering if it's just Mason as the individual managing member. During COVID, we lost three people in our managing member entities, but in every case, because of our policy, there was someone else. I would never advise an investor to invest in a deal where there's only one member, even if that member's in an LLC, because some states say that if the single member of an LLC dies, the LLC is dissolved. Now, what do you do? Your passive investors don't want to step in and run this. That isn't what so it's risky. The second question, as I said, is, hey, Mason, have you done this before? And you have to have a good story to get the first one done. But as soon as you get the first one done, you say, hell yes, once. That's all I need. You need to get past the first deal. That's why the first deal so many times is friends and family. They've watched what you do. They know what you do. They'd love to, if you see an opportunity out there, they'd like to get in on it. Okay. The third question is, are you putting any money of your own in the game, Mason? And that's a combination of cash and signing a loan. However, you can tell the investors that yet you do have skin in the game. That's important. And the fourth question is, Mason, if I'm in the deal and something happens to me and I need my money back, do you have a plan for that? And your answer there is, well, yes, we had a professional draft the operating agreement. And Trowbridge, when he drafted the operating agreement, has Article 11 and Article 12 that talks about liquidity, whether it's voluntary or involuntary. So we'll read that and see if that satisfies you. So far, I've been talking about cap rate, cash on cash. I haven't talked about any of those things because those things are all secondary. We expect all those things to be right. But those four questions is what I would consider my first interview questions. And the most important one is continuity on the manager.
Okay, so say it's me and one other person, and something happens to both of us, like we die in a plane crash because we're on the same plane. Then what happens?
Well, the LLC, there's two stories there. The LLC may dissolve. Okay. And if the LLC dissolves, it probably goes, if you're the only two, are you the only two investors or just the two in the manager group?
The manager group.
Well, that entity dissolves. So there's an LLC that owns the property that has all the other investors in it, but your LLC was managing that. So now that LLC goes away. And what does the lender say? The only people who can sign are dead. So it's going to take some effort. Someone's going to have to step up and take control and be elected the new managing member. We always have a provision in there that for cause, and that would be one of the causes, you died, we could replace you. And it takes a vote of 75% of the members to replace you. But that's a challenge because oftentimes The lender wants that person on the note. And you didn't bargain for that when you signed up and you gave them your $25,000 to be a passive investor, right? We've got a deal right now where unfortunately it was bad management, but we've got a sponsor who has 16 funds that are all in default. And there's a legal battle of what's going on. The members would like to get rid of that guy. That guy doesn't want to be get rid of, and the lender has control because the lender won't let that guy off the hook because that guy's got a lot of money. These deals are bad, but he's got plenty of money. So the lender says, hell no, he signed the guarantee. And so they're at a standstill. They can vote to replace him, which they've already done. But that's all subject to the lender. And I know they are in negotiations with a group who has some financial wherewithal who might come in and replace that person. So, but you be careful. There's always three parties in the deal. There's the passives, the active, and the lender.
Yeah, that was another thing I was thinking was, would it ever go into like some court-appointed receivership and the receiver's the one making decisions?
It could. We could go into, I know our dispute resolution provisions take you through mediation and arbitration and whatever. We try to keep you out of court because that just eats up too much money. We try to get a settlement, but it could very well be a court appointed. The bank probably has something in their loan documents that says, if you guys can't come up with someone else, we're going to take over. In fact, there's something called a springing member. If you are doing a big Fannie or Freddie loan, 30 million and up, I think is the number, they're going to have a springing member provision in the loan documents. And the springing member is just simply when everyone else who could make decisions is gone, this person will spring into action and take over all the authority and do everything that's right in the loan documents. So the lender has already agreed to it. And who is the springing member? It's usually an established corporation, national registered agents, some of the other people who are in this business all the time. Their corporation will become the springing member, and they will assign someone on their staff to be the individual. And the reason why it's important that the corporation is there, the corporation goes on and on and on and on and on, that people leave companies. So I can't say to my people, well, he isn't invested in the deal, but if anything happens to me, Mason has agreed to step in. Well, that might be okay now, but what about 7 years from now? How do you know? So that's a way to do it, a springing member.
And that corporation would be paid a fee or something?
They get a fee to start out with, and then they would step into place and collect management fees. Depending on the operating agreement is that the promote may not go away. And so the question is, where does the promote go? Maybe it goes to the heirs of the people who were in the managing member who died in your situation. I really don't know how that is. That would never be in the syndication documents. That's in your estate planning. When I was a syndicator, I used a sub-S corporation because a sub-S corporation has ongoing life, and my wife was a shareholder and I was a shareholder. So if something happened to me, it would continue on. Now, the problem is my wife was a school teacher, not a real estate professional. So I had a board of directors. I had an attorney and a CPA on my board, and I funded that with life insurance so that if anything happened to me, the board members could hire someone to replace me, and the money would be there right away to replace me. And that all went through the due diligence plan at the broker-dealer networks and was accepted by everyone.
Okay. Was that term life insurance or whole life insurance?
term. Just,
Okay.
and it wasn't an awful lot. I think it was $250,000. I started out buying a term policy for every offering, and it got to be kind of ridiculous because you didn't need the term policy to pay anyone back. Projects were good. They don't need to be paid back. You just need to have someone there to work. So I think we had $250,000, which would have hired someone because there were fees. There was money available because all of our projects were ongoing, but that would immediately let you hire someone.
Okay. And I guess the term of that insurance policy would be equivalent to the holding period for the deal.
Oh, I think I bought 15 years
Okay.
because there's one policy that covered 16 funds, so you never knew when the fund was going to. So I think we bought a 15-year policy. And then when I went out of business, there were a couple of years left on that. I just canceled it.
Okay. That makes sense. It's funny you mentioned that guy with the problem with the 16 funds, and it leads me to the next question of what are some pitfalls? Let's talk about that example. Like what happened with that guy if he's well off personally, financially? Why did all of his funds have issues? And what are other issues people should be aware of as they're doing these syndications?
Well, and I can speak to that issue. What the investor should have done is they should have looked at the quarterly statements that came out. Because in this case, some of the investors were getting a cash distribution, where if you had looked at the quarterly statement, you would have found that there was no cash to distribute. There was no positive cash flow, but maybe from reserves or from somewhere else that's yet to be determined, he was writing checks to investors. So I think that's the very first thing to do. Just because you're a passive investor, don't forget about it. You have to manage. You have to look at it and see, how is this going? You look at your bank statements every month, don't you? So you should look at your investments. That was, and I think he grew too fast. I think he just grew too fast, but he has plenty of money now. There's nothing that would require him to use his money to solve all those problems. In fact, in the offering documents that we write, we say the manager can advance money if they want. The manager can borrow money from other people and other places to solve the problems, and the manager can make a capital call. Well, the capital call is the last thing because it's the most ineffective deal of all. People aren't going to, if they think it's a sinking ship, they aren't going to invest more money. They're not going to put good money after bad money. So you've got to solve this before you get to the capital call, or have a really good plan, an excuse of why you need a capital call. And that may be coming up here now in the next year as interest rates are going stronger and people have a lot of bridge loans with variable rates. It's possible that at some point in time, some funds are not going to be able to make the monthly debt service payment because the interest rate's gone up so much, and they're going to reach out to the investors for a capital call. Now that would seem to be a reasonable explanation, and you'd think investors would come through. But you can't hold a gun to any investor's head. You need, in my documents, you need a 75% vote of the investors to have a capital call, but no one has to contribute. You can't take their money from them. You can't take their ownership from them. You can dilute their ownership if some people put in more money. So instead of having $1 million split evenly between 10 people, let's say we have $1.2 million because these people put in extra 200, where their 100,000 has grown by 2. The other guys has grown by 2. And now everyone else, you recalculate the percentage. So everyone's ownership gets diluted if you haven't contributed. Well, that's a penalty, but you haven't contributed, so you're okay. And thanks to the other people who have solved the problem.
Okay. Yeah, I guess it just really depends on each passive investor's personal situation and if they have capital to do. But I feel like it's
absolutely. And how much do you need? We've seen capital calls that are successful when it's $100,000 split among 30 investors. But if it's 4 or 5 million, then we've got an issue. And generally, if it's that much, there's been some catastrophe. There's been a fire. There's been some lawsuit, something that's really major. And at that time, you might as well just bail. There's a hurricane or whatever.
Okay. Well, yeah, I guess some of those disasters, hopefully you'd have insurance policies to cover it so you don't have to reach into the
Hopefully.
pockets of your investors.
Yeah, a lot of things can't be covered by insurance, but you never know. Floods?
Okay.
How about floods?
Yeah. There's flood insurance policies though, but if you may not have that at flood insurance, if you didn't anticipate the flood, right?
Yeah. And sometimes policies are so expensive that it's a business decision. And I write that in the document, it's the business decision of the sponsor on whether they're going to buy that type of insurance. If I'm in Louisiana, I'm probably buying flood insurance. But if I'm, 100 miles inland in the Panhandle of Florida, I don't know if I would. And so you run the risk, right?
Yeah, that makes a lot of sense. So how would someone go about identifying properties that have issues servicing their debt?
Well, first of all, you have to be pretty good at going back and making sure you get truthful, actual historical pictures of their cash flow. And then I think you have to make a judgment on what's happening. Let's say we're talking about multifamily. You have to make a judgment on what's happening in the area. Are jobs coming in the area? Are households being formed in the area? Is there a lot of new construction in the area that's going to suck off your clients? Is COVID going to cause you trouble? Okay, a lot of things you can't foresee, but that's how you would do it. You'd have to do your due diligence and their financial statements. Now, if the property owner has no financial statements for the history of their property, I'd go somewhere else.
Okay, well, I'm just thinking if I wanted to identify distressed opportunities where I could buy from these sponsors that are struggling to service that debt but don't want to lose it to foreclosure and would rather sell it to me and my investor group, for example, hypothetically, how would I go about identifying these being on the outside of that deal?
I don't know. Sometimes they put the word out that they want to sell. Okay. But other than that, how would you know? How would you know if their interest rate cap has been blown apart? How would you know? I don't know. I guess there are some states maybe that the loan documents are recorded. I really don't know that answer. It's been a long time since I've been out trying to source my own deals. And in my deals, it was just dirt. Is this dirt in this location? Does it look like it would meet a demand for self-storage? And can I get it zoned?
Okay.
Since there's no history, I never had to worry about history.
That makes sense. That due diligence sounds similar to even today's. Like, what's the likelihood of me rezoning if necessary to whatever it needs to be? And then is the market already saturated? Looking at like square feet per capita in that area versus national average and all that.
Yeah, you should have an exit strategy whenever you buy a piece of real estate. What's going to happen? For a long time, a while ago, lenders underwrote their loans twice. They underwrote it today, and they underwrote it at the end of 7 years when the loan is coming due. And their question was, well, at the end of 7 years, what will the property be worth? What will the NOI be? What will the cap rates be? What will the property be worth? And will the owner of the property be able to find a different lender to refinance? Because the current lender doesn't want to refinance. So they look at that. So there's always some projections. We have that right now. Our rent's going up fast enough to offset the rise of interest rates. And if things get tough, have the cap rates, have they stayed close enough to the rising NOI So we still have a good value of the property. I mean, if interest rates go from 3 to 7 and your rent is stagnant, you're not going to be able to pay your mortgage payment, and your property hasn't gone up in value. So you're not going to be able to refinance it. But the good news, I know it sounds kind of dire, doesn't it? The good news is, at least in the multifamily business, there's an imbalance of supply and demand. There's more demand than there is supply. So even in this COVID period of time, rents are going up all over the country. So property owners are doing okay.
And do you feel like that's also rents are going to continue increasing as people are priced out of the home buying market and they're forced to rent?
Absolutely. Absolutely. You know, when you think about 1/4 of your income can go to housing, and you get underwritten, and interest rates have gone from 3 to 7, you know, you're going to have a smaller mortgage. You can't buy a smaller house. So you might as well just stay a renter. I'm sure that's the problem, in my opinion, and I'm not a guru on this, but their housing formations are growing faster than housing stock. And apartments are being built faster than single family houses. So all the new households are going to have to look at some sort of an apartment living style for a while. I mean, before, the problem was within the last 2 years, every time a property went on the market, there were 20 offers and the bidding went way over the listing price. Now we're kind of in a buyer's market, at least for right now, more of a buyer's market. And then the question is, well, do people want to sell in a buyer's market? To say nothing of older people, I can speak to that. I'm in a house. I've been in there 35 years. It's not paid off yet, but I'm pretty close to it. And if I moved to another house and paid today's prices to duplicate the house I have now in today's market, it would be, the payments would be twice as high. Well, I'm just staying where I am. And that's a problem in the single family residence business. People aren't selling, they're just staying right where they are.
Huh.
Every month I get a realtor somehow asking me if we aren't quite ready to sell, because they can check the records and see how long we've been there and see my white hair when they drive by and say, gee, this guy's probably going to want to sell. So
okay. But actually kind of segues into the build to rent. I mean, the build to rent communities have been around, but now they're obviously gaining in popularity and hearing more about it on the media, you know, instead of just building
I've done all sorts of offerings for people that bought dirt and either put in the infrastructure and then stopped, or then went out and built houses and sold them on lease options.
What's the overall allocation of like multifamily versus other types of deals that you're usually working on?
Oh, in my company, going back to about 2008, when the market fell apart and then it started building up again. We're probably at 70% multifamily, and then followed by self-storage, because I have a history in self-storage, so people seek me out. And then some of the multifamily sponsors I've worked with for a long time are moving into mobile home parks for increased cash flow. And I even have one guy who's moved into RV parks, where he's building RV parks, which is both the mobile home parks and the RV parks, I've heard, are people's thoughts for low-income housing.
Huh.
Because you can live in a mobile home park, unless they're the ones that are in California that are on the ocean, that are, you know, a pad is sell for $3 million, you know. But for most parts, mobile home parks and RV parks are less expensive than apartments.
Okay. Yeah, I've heard some places in Florida have had selling for easily like 150,000 or 200,000. Pretty crazy. But it all depends on the market. Every market is different. So
Sure.
makes a
And
lot of
that's an
sense.
interesting deal. When the sponsors go from multifamily to mobile homes, I always have a conversation with them because there's a rule that the investors are supposed to be sophisticated enough to read the documents and figure if the risk is worth it and if they can handle the risk and understand what's going on. But what about the sponsor? Sponsor knows all about apartments. Go over and buying a mobile home park where you're going to own the coaches. Because I've gone to a couple of educational events on mobile home parks, and one of them they had a 3-hour video inside of a manufacturing plant where they build the coaches, and it's totally different than apartment construction. And so if you're going to own coaches, do you know anything about it? Do you really know anything if you're just going to simply own pads and it's on a septic system, your own sewer system? You know enough about that to put your investors' money in there. I think it takes some studying. And investors are supposed to be sophisticated. So if you change from one product type to another product type, the investors should be sophisticated in that new product type. And our sponsors aren't in the business of educating the investors. I mean, you do through your podcast. That's terrific, but a lot of sponsors don't do that. So there are a lot of places that an investor can go in the market and learn about mobile home parks and learn about self-storage industry and learn about alternative investments. But the one that we haven't seen very much is office buildings in the last 5 or 10 years. I don't even think I've done an office building. We've done
Interesting.
some industrial. Retail, I've got 2 people who are doing blind pools, $15-20 million blind pools, and going out and buying Dollar General and Family Dollar and Walgreens and single tenant net lease properties for the cash flow, not for the appreciation, but for the cash flow.
Okay. Yeah, I would think too, like with some possible secular shift happening with office space, there might be some conversions happening. Your conversions.
I've got a client in Texas who's doing conversions in Texas and Cleveland, doing office buildings and converting them to apartments. His strategy is if it's mixed use where the first floor is retail, maybe the second and third floor are office, and then top 20 floors are apartments, he'll master lease the top 20 floors to people who are in the business of running apartments like that. They don't own the building, but they take over the management, and it's a master lease. That's pretty good. I mean, the one property is kitty corner from the Rock and Roll Hall of Fame, and it was a relatively impressive office building when it was built, but times change, and it'll be a very impressive multifamily property. Very impressive.
That's interesting. So would the master lease work such that the company pays that operator a certain amount and then they're just trying to collect that spread by leasing it out on an individual basis, kind of chopping it up, right?
Right.
And make it okay. Interesting. And are those usually like triple net leases where they're paying all the expenses for those? Oh, wow.
Of course, a lot depends on the building, but by the time you get through rehabbing and renovating those buildings, one of the projects that one client did was the Rockefeller building in downtown Cleveland. Well, you can imagine with that name, it's not a brand new building.
Yeah.
So there was a lot of renovation. Just think about taking an office building and putting it into apartments. Each apartment has to have its own kitchen and its own bathroom, right? So you can imagine there's a little bit of work to be done.
Yeah, but interesting.
All right.
Yeah, that's very helpful. This has been very enlightening. So if anyone wants to learn more about you or work with you on one of their syndications, how do they learn more?
Sure, I'm taking new clients. We are taking clients all the time. There's 6 of us in the firm, so we have plenty of ability to work. One of the things they could do is they could go to my website and schedule a free consultation with me, trowbridgelawgroup.com. That's TROW Bridge lawgroup.com. Or they could call the general number 949 570 1507. 949 570 1507. And I want to make sure people know about my YouTube channel. Very full of education. I have just educational stuff that Jonathan, my law partner, and I do. And then I have interviews with 37 of my bigger clients. How did you get in the business? What do you think's happened in the next 3 years? And what advice do you have for rookies? Those are the 3 questions I ask it. Interestingly, Mason, without exception, every one of the 37 people said they got in the business because they found a piece of property that they couldn't buy by themselves. And so they needed to pool money from other people, and that got them started in the syndication business.
Interesting. How would we find your YouTube channel?
Trowbridge Law.
Okay. Perfect. Yeah, I'll be sure to put those links in the show notes as well. But thanks again for taking the time to speak with me, and hopefully everyone's learned a little bit from this. I know I have.
Good. Well, thanks. Maybe I'll see you again. Thanks very much. Bye.
All right, that's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom, and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON@scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.